Well, hello everyone. Welcome back for week 7 of our financial wellness bootcamp. I hope you're all doing very well and you're staying safe and you're staying healthy. Just to reintroduce myself to you guys from last week, my name is Jordan Fuller. I'm a local financial professional here with Walio, and I'm excited to spend another week here with you guys to impart some great information to help you on your financial wellness journey. Income protection. So income protection is the ability to continue receiving adequate financial support after calamities cause a loss of income, right? So your most valuable asset is not your house, it's not your car or your checking account or your retirement account, anything like that. It's your most valuable asset is your ability to make a living, right? So as long as you're making an income, you can sustain yourself, you can sustain your family, your necessities, your obligations, your lifestyle. Everything starts to go downhill, however, as soon as you lose your income. And it gets even worse when you lose your ability to make an income. So income loss can be caused by several different things. One of the first ones, job loss. Now, in this year specifically, in 2020, 1 in 4 Americans say that job loss is likely to happen to them. It's not too surprising. We're in a global pandemic. It makes sense. Now, what we're going to show you today, or what I'm going to hopefully show you today, is what you need to know in case you lose your job, what avenues you could take to help you cope with that kind of circumstance. All right. Now, income loss, it can also be also happen due to disability, whether that disability is caused by an injury or an illness. All right. Now, 40% of Americans will develop a chronic illness that will impact their income earning abilities either temporarily or permanently. So chronic illness, it could be anything like cancer or Alzheimer's, something like that, maybe diabetes in a severe case. In fact, did you know almost 1 in 5 Americans are disabled, and a disabling injury occurs in the United States once every second? And that's, you put that all together, that's 30 million people per year. Now, today we're going to talk about all the options you'll have in order to protect your income from disability, right? And now income loss, finally, the last one we'll cover is it can be caused by death, specifically the death of a breadwinner in the family. Now, nobody likes to talk about it, but facts are facts. 2.5 million people die annually in the United States. 2.5 million people die in the United States per year. And 75% of premature deaths, they come from heart disease, kidney disease, and cancer. So have you ever thought about what would happen to your family if you were suddenly no longer here? Or in the case of if you're watching this and you're the person who's dependent on someone else's income, have you ever thought what would happen to you if that person was suddenly no longer here? Right? These are things to think about. So it's wiser to have a plan in place and not need it than to need a plan in place and not have it. Income protection is a critical part of your personal financial plan. Now, there are a few common ways that we can protect ourselves from income loss. If you are employed, if you're employed and your job is your income, then you're protected in some ways by what we call unemployment benefits, workers' compensation, and in some states, they have state disability insurance. So if you live in one of those states, that would be the case. Now, it's not enough, or excuse me, I should say this, if it's not enough, you having those kind of safety nets, what you could do is you could always diversify your income and build alternative income streams, something like we introduced in the previous lesson. Another thing you could do is you could also buy additional insurance. So let me jump into that a little more specifically. So what you could do as far as your income streams, you could diversify your income by building multiple income streams. Okay, so a second income, that in and of itself could be a form of income protection, right? As far as your protection for your primary income, and it can continue long term. So say, for example, if you had 2 jobs and you lost the first one, right? The second one could be a replacement, at least partially, for that first loss of income, right? Now, what you also can do is you could also start building a passive income stream, right? So a passive income stream would come from something like owning dividend yielding stocks, income properties, annuities, or maybe having a share in a business, right? So those are ways you could build passive income streams. Now, if having a business on the side or second job is not an option that you think is viable for you, you could consider insurance policies. Now, insurance is an easy and affordable way to protect your income. It guarantees you compensation as long as you're paying the premiums. Now, disability insurance, it complements your health insurance and provides short-term benefits just in case of a full or a partial income loss. So if you own a business that brings you an income, then there are a variety of insurances available to you to protect your business income. Insurance protects a business if it is unable to operate due to property destruction, equipment disruption, key employee loss, or if we're going to be specific about today's times, a pandemic, all that kind of stuff. It's going to make sure that your business can survive if it can't operate the way it normally would. Now, life insurance, it pays out a sum of money upon the death of the insured person. So this is one of the most critical insurances that everyone who has dependents needs to have. Now, fully funded emergency fund is great, but it's never going to be enough to replace the income of a primary breadwinner for any substantial long period of time that a family depends on, right? So let's start looking into each one of these a little bit more specifically, one by one. So the first one we're going to cover is unemployment. So what is unemployment insurance? So unemployment insurance provides unemployment benefits in the form of weekly payments to eligible workers who become unemployed through no fault of their own. Right? So if you worked more than the minimum set amount of time and you weren't fired for any justifiable cause, you can file for an unemployment claim and start receiving your unemployment benefits from the government. You don't have to pay for it. You don't need to buy it. You don't need to worry about it. The benefit is provided out of the taxes we pay to the government, right? So it comes automatically. Now, unfortunately, there's no easy way to calculate exactly how much money you'll receive through these unemployment benefits or for how long you'll be able to collect those benefits. It depends based on which state you're living in, right? Now, typically, a benefit that you would get would be around half of your normal paycheck. And it would also typically last for about a maximum of 26 weeks. Now, some states provide benefits for a lower number of weeks, and the maximum benefits, again, also vary based on where you live. Now, there are calculators. It can't give you an exact number, but it can estimate the benefits that you could receive if this becomes a viable option for you. Now, unemployment benefits are also considered taxable income, and the unemployment compensation you receive must be reported when you file your federal and state tax returns. Typically, the tax withholdings are going to be about 10%. In fact, let's show you an example. Let's see how much of your lifestyle unemployment benefits may replace. All right, let's look at an example. So let's say, in our example here, let's say you're making $6,000 a month, right? You have all your bills, your savings, and your spendable depend on this $6,000 a month, and you have a positive green outlook for the next 12 months, so January to December, right? And so you have a full bucket. Your $6,000 a month is going to equal $72,000 a year, and this green bucket indicates all of the income you need to maintain your current lifestyle. But then something happens. Boom, you lose your job. This is not good, right? So again, you're going to need to find a way to find this $6,000 a month over the next 12 months in order to maintain your lifestyle. So the first thing you're going to do, first and foremost, is you're going to apply for the unemployment. Boom, there you go. Here's your unemployment benefit right there. Now, as I said on the last slide, unemployment benefits usually pay half of your normal paycheck, right? And they last for about 26 weeks or 6 months. Okay? Max in most cases. Now, unemployment certainly brings something. See, it's better than nothing. But I'm sure you can see it too. I still see a huge red cash hole over here, a big one, right? Now, with unemployment, I can only maintain in this scenario about 50% of my lifestyle, right? And I can only maintain that 50% for half of the year. It's not going to be enough. Now, if you've built a fully funded emergency fund, or if I built that fully funded emergency fund that I talked about in the last lesson, then I'd have a little bit extra insurance here, right? A little bit of a cushion. Now, the emergency fund, in addition to the unemployment benefits, would allow you to keep 75% of your lifestyle for a total of 10 months. right? It's a little better than just this scenario. So for the first 6 months, you're going to be burning through your emergency funds slowly. Hopefully, you're looking for a new job, and hopefully you find one quickly so that you can preserve the bulk of this fund here. But if not, your emergency fund would be enough to sustain you for another 4 months after your unemployment ran out. Now, statistically, it takes 8 months on average to find an equal job replacement after one is lost, right? Now, if you're lucky and you get back on track quickly, then you can preserve a huge chunk of your emergency fund, or at least a substantial chunk of it. Now, if you're unlucky and a little slower than average, then you still have an extra 2 months here to sustain you. So I hope you understand even more fully why having that fully funded emergency fund is critical for your financial wellness. Unemployment is only going to get you so far, okay? Now, what if you got hurt at your job and you couldn't work anymore? Now, if you get hurt on your job, your employer is required by law to pay for what's called workers' compensation benefits. Now, California, they have a no-fault workers' compensation system. It ideally benefits both the employees and the employers. So workers, they can't sue their employers in court. And in return, employees don't have to prove that their employer was at fault for their injury, only that the injury was work-related, right? So you see how that works for both people. Now, all payments and non-cash benefits from workers' compensation are going to be received tax exempt, right? And workers' compensation, it comes at no cost for the employee since the employer is required to pay for it. Now, let's go over some of the compensation benefits. First one is going to be your medical treatment costs. So these are going to be paid for by your employer to help you recover from an injury or illness that's caused by your work. So this is going to include doctor's visits, tests, medicines, equipment, reasonable travel costs that are necessary to treat your injury, things like that. Next thing is going to be temporary disability benefits. These are going to replace part of your income if you lose wages because your injury prevents you from doing your usual job while you're recovering. Then you're going to have permanent disability benefits. These replace part of your income if you don't recover completely and your injury, both physical and mental, permanently prevents you from doing your job, okay? Your life pension. This is a small weekly payment in addition to the permanent disability payments for workers who are severely disabled. These payments last a lifetime. Now, vocational retraining costs, they help to pay for retraining or skill enhancement if you're eligible to receive permanent disability benefits. Your employer, they don't offer you your job back, or you don't return to work for the employer. This is where vocational retraining costs come in. And then last but not least, there's death benefits. So if a worker happened to pass away while on the job from either an injury or an illness, their spouse, children, or other dependents, they would receive some death benefits for some time from that company, right? Now, certainly it's not going to be enough to replace their income over a substantial period of time, but it is something. So also, before we move on, it's important to note that workers' compensation may not cover an injury that is reported to the employer after the worker is told that he or she will be terminated or laid off. It has to be done before. Okay. Now, the chance of missing months or years of work because of an injury or illness, it may seem remote, especially if you're young and healthy. Maybe you work at a desk in a cubicle, something like that. But actually, 1 in 4 20-year-olds will experience a disability for 90 days or more before they reach the age of 67. This is according to the Social Security Administration. Now, there are 2 primary types of disability insurance. There's going to be short-term and there's going to be long-term, right? So insurance companies tend to offer different disability policies. So it's always best to kind of shop around and figure out what exactly it is you need, and then figure out what it is companies, or I should say insurance companies, actually offer to figure out what's best going to fit you in your situation. In fact, disability insurance is also a double whammy because it covers not only your expensive medical bills, but it also covers lost income as well. So let's just do a quick comparison between these two. So short-term disability insurance usually is going to cover about 60 to 70% of your base salary, whereas long-term is going to cover between 40 to 60%. The benefits for short-term, they're going to be a little shorter. They're going to last 9 to 52 weeks typically, where Long-term disability is just that. It's much more long-term. It's going to end when the disability ends, or if it's very, very long-term, then it's going to go on until you reach about the age of 65, typically when most folks try to retire. Short-term disability, the waiting period before the benefits kick in with short-term is going to be about 1 to 14 days. It's going to take a little bit longer with long-term, up to 90 days before the benefits kick in. Short-term disability benefits are usually going to be offered by the employer, whereas long-term is usually going to be offered by insurance companies. However, in some cases, it can be offered by the employer as well. So there's different benefits, there's different structures to it. You have to figure out which one is going to best suit you in your situation. So this slide highlights one more reason to build that fully funded emergency fund that I've told you about. If you have that fund, then you are essentially self-insured from a short-term disability. Now, on the other hand, the emergency fund is not going to be enough to cover your income from a long-term disability. So out of the two, I would suggest having long-term disability insurance and then keep building your emergency fund so that you can self-insure from a short-term adversity. Does that make sense? So here's some ways that you can get the coverage. So you can get coverage either from your employer or you could buy it from an insurer. Now, most employers are going to offer some kind of disability insurance, but you should find out exactly what your employer offers before you file a claim. You'd want to know that beforehand. That's the best avenue to take. Most likely it's going to be a short-term policy though. Remember, usually employers are going to offer short-term disability insurance. It's also, just important note, it's also common for coverage to kick in only after you've worked for a set period of time at this job, or if you're working for at least 40 hours a week. So it's important to note that. Now, there are 5 states and Puerto Rico that have state disability insurance. So those 5 states are California, Hawaii, New Jersey, New York, and Rhode Island. So these state programs are designed to partially replace wages of workers who are very ill, injured off the job, and unable to work. So again, check with your specific benefits department to see if you're covered. And if you are, how long you would have to wait before your benefits would begin and how long those payments would last while you're disabled. So some employers actually, they don't pay for disability coverage, but offer it as a voluntary benefit. So again, you have to look into your specific company to figure out how it works for you. So long-term disability insurance provides coverage if you're out of work for a longer period of time. Now, that makes sense. I want you to be thinking years or even decades. It's sometimes offered by employers, but the benefit is not commonly. People usually have to buy long-term disability policies from insurance companies. So reasons why you would consider buying it: maybe if you don't have any kind of disability insurance, maybe you don't have enough coverage, or if you're self-employed, that would be another reason you might want to look into buying some disability insurance. Now, insurance companies have a limitation to the amount of income that you can replace. Generally, you can't replace more than 75% of your gross income. Now, this limitation isn't a problem because your benefits, remember, aren't being taxed. The policy that you have that pays out, say, 60% of your gross income would effectively replace most of your take-home paycheck. So I want you to keep that in mind. 60% replaces most of your income. 75%, it pretty much replaces your entire take-home income. Now, the annual price for a long-term disability insurance policy is generally going to range from between 1% to 3% of your annual income. However, a variety of factors is going to affect the cost. So again, you do your due diligence and figure out exactly how much it would be for you in your situation. So like I said before, there are 5 states that have a state disability insurance program. There's California, Hawaii, New Jersey, New York, Rhode Island, right? So if you live in one of these states, pretty much you shouldn't have to worry about short-term disability. You should be covered, right? However, you would still need to have proper protection in place for a long-term disability. Now, the maximum amount of time you might be allowed to collect those benefits would be for 52 weeks for a disability, and then 6 weeks for paid family leave. So say if you needed to take time off to take care of a spouse, domestic partner, child, parent, or another immediate family member, some kind of dependent, then paid family leave would cover you for about 6 weeks, or cover your wages, I should say. Now, the amount of weekly benefits you receive would vary state by state, and it would vary by the individual as well. generally, the more money you're making, the higher amounts of benefits that you would receive as well. However, each state is going to cap the maximum amount of benefits it offers. So for California, it varies anywhere between $50 to $1,129 a week, which is not going to be enough, if we're honest, to replace the income for a highly paid individual. So if you're living, excuse me, even if you're living in one of these 5 states, your emergency fund is going to be your friend. Never ignore your emergency fund. It has so many uses and can fill so many gaps. So before we move on from this disability insurance topic, let's take a glance at all the options in one slide, right? So all states require employers to have workers' compensation, right? So workers' compensation provides coverage for workers when their injury or illness is caused by their work, and it's not covering them when the injury is not work-related. That's important. So most disabilities are results of non-work-related injuries. So if you can't work because of an injury you suffered on the weekend while moving furniture or something like that, or attending a spin class at your gym, something like that, then you'd only be covered if you live in California, Hawaii, New Jersey, New York, or Rhode Island. You'd have short-term coverage right out of the box in one of those states. Now, if you live outside of one of those states, then you might need some short-term disability insurance. However, my personal advice is put that extra effort into building your emergency fund and self-insure. Again, emergency funds have so many different uses. They can fill so many gaps. Now, long-term disability insurance, this is going to be purchased from insurance companies. This is what pays for non-work-related injuries. And it might pay, in some cases, for work-related injuries if your workers' compensation benefit was denied. Now, long-term disability insurance makes sense to have, and personally, I recommend that you do have it. So pretty much if you have an emergency fund, which everyone should have, you have workers' compensation, which everyone gets out of the box, the only missing link in the chain is the long-term disability insurance in order to achieve full coverage. So this insurance should form an important part of your personal financial plan, particularly if your work-related income is the only income that you and your family can rely upon. Now, I'm just going to go over this slide fairly quickly. I'm not going to expand too deeply on business income protection topic. I mean, it really deserves its own class, and it's a whole separate conversation. However, I will provide an idea of how business owners can protect their income or how they go about doing so. So business income insurance, sometimes known as business interruption insurance, helps cover lost income when a business has to shut down due to a covered peril. For example, a covered peril might be something like a fire or theft or weather disaster, or even a key employee leaving, which is an interesting circumstance. So if a business income depends on the performance of one key employee, that business may actually lose income if that employee cannot work. So whether that employee is injured, they decide to quit, or they pass away, that business income will be interrupted. And there is insurance that can be put in place to protect from this. So these insurances is going to pay for the actual loss of business income due to suspended business operations. So whatever causes that business income disruption, the insurance will pay to cover that lost income. Now, it's very similar to disability insurance if you've been paying attention, right? Now, this coverage is being used by businesses during the current pandemic by business owners in order to stay afloat until normal business operations can resume. So income protection is a serious topic, and businesses and business owners take it very seriously. So if your job is not your only income, you need to think about how to protect and ensure other streams of income that you may have. So what else can you insure? Now, you can insure pretty much everything that helps you make money. For example, there's actually something called body part insurance. So say, for example, if you're a surgeon, you can insure your hands. Bruce Springsteen can insure his voice. Julia Roberts, she makes a lot of money off that smile. It's her signature smile. And I'm not going to go into what J-Lo insures. You can kind of make your own determination on that. But people who are dependent on specific body parts to make money may insure themselves against the loss of income from damage to those body parts. I want you to remember our financial planner from our first 4 lessons. You remember Matt Michelson? Now, Matt has a friend who is a chiropractor, and that friend suffered a severe shoulder injury while he was on vacation. Now, this injury put him out of work for months, right? Which meant his clients had to go to other doctors in the meantime. And because of this, unfortunately, he was eventually forced to sell his business, or I should say his business was had to close. Now, while insurance won't prevent a negative event from happening, it can make a lot of financial sense if it's set up correctly. So the point of insurance is to transfer risk from the individual to the insurer at a reasonable cost to protect that individual from risk of a significant or even catastrophic financial loss. So as we can see, people insure anything that could cause a loss of income for them, whether it's a general disability, a specific body part, or a business. Now I want you to think of yourself. If you're not a business owner or Julia Roberts or a surgeon, how can you insure against a loss of income? If you rely on your job as a primary source of income, you should probably consider long-term disability insurance for your own financial protection. Now let's move on to the next topic of today's discussion, life insurance. Now, I personally think life insurance should be called death insurance, right? You're not really insuring from life, you're insuring from death, right? But this topic, understandably, is very uncomfortable to talk about for so many people. So uncomfortable, in fact, that the industry decided to give it a better name, which is why it's called life insurance instead of death insurance. I mean, I understand it. People are reluctant to talk or even think about death. We despise it, we hate it, we run from it. But at the end of the day, we can never escape it. In fact, as Benjamin Franklin once said, there are only two certainties in life, death and taxes. We can't escape from them. But what we can do is we can minimize our taxes and we can insure from premature death. So consider what were to happen if you were to pass away. Would your family be able to afford their current standard of living? I want you to think about all the things that your income pays for, your mortgage or your rent, heating, water, other utilities, groceries, clothing, education. The list can go on and on and on and on. Now, would your family be able to cover all of these expenses if your income was no longer part of their budget? So income replacement is one of the main reasons that so many people, especially those who have loved ones depending on them financially, have life insurance. So yes, I totally understand life insurance is not a fun topic. I get it. But it is a critical part of your financial plan. Life insurance, it doesn't insure your life. It ensures your family's ability to continue on without you without being financially devastated. Now, this concept, I really like this concept. This is what we call the X curve, right? So the X curve is a simple way to show the relationship between taking care of your responsibilities and building your wealth. Now, the main point of this concept is that a person's responsibility decreases and their wealth increases over time. So as you can see, the X curve, it involves two curves that run in opposite directions during your lifetime. So let's start with this one first. This is what we call the wealth curve. So when you're younger, you normally don't have a ton of money, right? This is the point in your life where you start to save and invest. Now, as you build up your wealth, the wealth curve rises. And hopefully, by the time you get older, you have enough money saved for your retirement and you can be financially independent, right? The wealth curve is your investment curve. Then we're going to come over here is what we call the responsibility curve. Responsibility curve is, when you're younger, this is when, this is the point in your life where usually you're starting a new family. There are high possibilities of having children, mortgage, expenses like car payments and college savings, debts, and all that kind of stuff. You and your significant other, if you have one, are going to be responsible for these obligations, whether you live or whether you die. So early on, when you're in this situation, this is when your need for insurance is going to be quite high. But, as time goes on, your children grow up, your mortgage matures, and you reduce your debt, your responsibility starts to decrease. Now, the X curve provides a clear approach for building your financial foundation. You're motivated to save and invest and accumulate your assets faster so that you can reduce your debt, mortgage, or liabilities sooner. So in life, there are two outcomes that can happen to you. You can either live too long or you can pass away too soon. So the goal is to make sure that you can protect yourself and your family by doing two things. One, you can have higher protection when you're younger. Protection like life insurance that would take care of your family, your children, their college education, mortgage if you still have one, all of those kind of expenses and responsibilities, having that protection to take care of all that stuff if something were to happen to you prematurely. Second thing you would want to do is to be able to save as much as you can so you can take care of your future once you hit your golden years and you get into retirement age. So the true meaning behind the X curve is responsibility. If people aren't responsible, then the concept is of no benefit. Parents can spoil their kids with lavish birthday parties and expensive toys and all that kind of good stuff, but then they don't have anything saved for their kids' college funding. It doesn't really make too much sense, right? Now, the person who has the responsibility, they know where their priorities are. It's their family's financial future. And quite often, the person who doesn't really care about protection for the family also doesn't worry much about saving for rainy days. So if they passed away too soon, their family would suffer. And if they lived too long, they may possibly end up being a burden on their children. So without responsibility, there is no need for insurance and there's no saving. There is no X curve, right? So just to illustrate this example, I'm going to tell you a quick story. We have an advisor here at our company named Steven. And a few years back, he was on an appointment with a family, just typical family, married couple. In this case, it was a husband and a wife. They basically exemplified this exact example here. They had, 2 daughters or 2 kids. They had car payments, debts, just like everyone else, a mortgage and all that kind of stuff. And Stephen was sitting down with them to help them put some financial plans in place or financial instruments in place. And when doing that, he discovered that the husband had no life insurance on himself. And being the good advisor that he is, he told the husband that in order for them to move forward with any kind of financial instruments, he needed to put that right foundation in place and protect his family. And the husband, he was smart enough to take some good advice, and he got the life insurance protection that Stephen recommended. Now, just to make a long story fairly short, unfortunately, a couple of years later, this husband, he was diagnosed with terminal cancer, and he eventually passed away. Now, had Stephen not sat down with this couple and gotten that insurance in place on this father, the mother, after her husband passed away, unfortunately would have found herself in this situation. Thankfully, because that didn't happen, this did not happen. Now, there's no amount of money that can ever replace a human being. Human beings they can't be quantified with a monetary amount. However, because Stephen was able to come to this gentleman's funeral with more than a bouquet of flowers, he was able to come with a check for over $1.5 million. This woman wasn't saddled with financial devastation on top of the emotional devastation that she was going through. She could keep her kids in their same school. They didn't have to have their life upended any more than it already had been. They could stay in their house. She could cover the mortgage. She could make all the regular payments on the debt they had outstanding. She could actually even put some of that money away from her for her own retirement once she reached her golden years, all because this husband had the foresight and the intelligence to take good advice that he was able to protect his family for when he was no longer here. So I just wanted to tell you that story just to illustrate the point that we're trying to make on how crucial having these kind of protections are for your family's well-being. Now, continuing our talk on life insurance, 37.5 million homes in the United States are currently without life insurance. That's about 30%. In fact, 62% of households say that they would be in immediate financial trouble if the primary breadwinner in their family died. So if this is the case, then why do so many consumers not have life insurance when they know that they need it? Now, one of the primary reasons could be that people drastically overestimate the cost of getting the insurance. Now, there is no one-size-fits-all coverage amount when it comes to life insurance. Everyone's need and budget are going to be different. Now, if cost is a big worry when it comes to getting insurance, one of the best options that you could look into would be term life insurance. Now, term insurance is always going to be the most budget-friendly option when it comes to life insurance, largely because it only covers the insured party for a certain period of time. That's why it's called a term. It covers you for a certain term of years. Now, that term, it can range anywhere from between 10 to 30 years. So I want you to keep in mind that they are the most budget-friendly option, but these policies only pay out if the insured party passes during the time of that term policy. That makes sense? Now, on the flip side of that, there's permanent life insurance. And just like it says in the name, these kind of policies will cover the insured party for the duration of their life. These insurance policies are permanent. And also with most permanent life insurance, there's going to be a cash value accumulation component to the policy. So due to this feature, as well as the permanent nature of it, this type of insurance is typically going to be more expensive than term. However, I want you to keep in mind, with permanent insurance and with term insurance, in both cases, the younger and healthier you are when you obtain a policy, the more affordable that they will be, okay? So just to dive in a little deeper to permanent insurance, here's a very quick explanation on how it works. Right, so every monthly payment into an insurance contract is going to be split into two parts, right? So one part goes towards buying the insurance, the other part goes towards the cash value. So here you have $100,000 in your 30s, about $750,000 in your 50s, and about $900,000 in your retirement. Your cash value is going to grow over time. Now, the insurance that you're buying from the insurance company is going to be the complete opposite. It's going to grow in inverse effect. It shrinks and becomes smaller. So when you're young, remember, this is when you have a lot of responsibilities and obligations, and your need for insurance protection is going to be significantly higher in these years, right? You're buying a lot of protection from the insurance company. So in this example, in your 30s, you're going to have $900,000 worth of protection. When you become older and wealthier, you have fewer responsibilities and obligations, and you need less protection. So in your 50s, you only need about $250,000 worth of insurance. And then you get closer to retirement, you just need a minimum amount of insurance. Now you have about $100,000. So permanent life insurance is going to pay no matter what. There are no term limits. So this particular insurance policy is going to pay out $1 million sooner or later, right? Now at later, that $900,000 of your accumulated money is going to be your cash value. And then $100,000 up here, that's going to be your insurance amount. That makes sense? Now you can access this accumulated cash value. It's your money. You can, jump into it or grab some from it at any time as you wish. You don't need to die to get access to the money is the point I'm trying to make. So you can use the money that's grown inside the insurance policy at your own leisure. You can access it tax-free. It grows tax-free. And if you were to happen to pass away before spending this whole amount, say you didn't spend the whole $900,000, the entire amount would then be passed on to your heirs, and they would also receive it tax-free, right? So again, term versus permanent, which one you should get, it's really, there's no blanket recommendation. There is no one size fits all answer. It's purely dependent on your personal situation, on your need and your budget. So this for you to figure out by looking at your situation holistically and then making the best determination for yourself and your family. So each policy has its pros and its cons. So whichever one fits you, that's going to be up to you to determine. So I want you to understand why the death benefits of life insurance are tax-free, right? So let's take a look at an example. I love examples. So let's just say that you have a car, right? And that car is worth $30,000. Now, for the sake of simplicity, we're going to say that your entire net worth is just the value of your car. It's $30,000. Let's just go with that. So let's say one sunny morning, you're driving to work and then boom, you hit a center divider on the ramp going 25 miles an hour. Maybe you didn't have enough morning coffee or something. I don't know. Now, luckily, you don't have any injuries. Everything is good with you. But unfortunately, your car is geometrically compromised, so to say. Basically, it's bent. It's totaled. The car is scraps now. Now, luckily, you have the right car insurance coverage. And so your insurance company would then reimburse you for the loss, right? So now you get your $30,000 back. Because if you were to lose a $30,000 car, they shouldn't repay you $40,000 or $50,000, right? No, The value of your car was $30,000. You should be reimbursed the exact value of that car. That's what's fair. So you get $30,000 cash from the insurance company. Do you need to pay taxes on it? Should you need to pay taxes on it? No, you shouldn't. You lost $30,000 when your car was totaled, and then the insurance company gives it back to you. You're not getting richer in any way, shape, or form. Your net worth is still $30,000. It's exactly what it was before your accident. Why should you pay taxes on something that's not bringing you any extra money and it's not making you richer? Now, accordingly, the amount is not your income as well, and that shouldn't be taxed. This is an income tax. You're not receiving an income. We as a society rightly decided not to tax insurance payouts because a person just gets back what they had in value. They're not getting richer, right? This is what's written in our tax code. Now take this car and replace it with a person, husband, wife, significant other, whichever fits the situation. Now, if the family lost a primary breadwinner and got an insurance payment, did that family become richer? No, because they lost their primary breadwinner and the insurance company reimbursed them for their loss. Now, again, it is so difficult to put a number on a human life. We're not cars, we're not inanimate objects, right? But when a family or a person gets an insurance policy, obtains a life insurance policy, they're essentially estimating how much that breadwinner would have brought in income had they not passed away, right? So the death benefit is just as tax-free as the reimbursement paid for your car. So all life insurance death benefits are tax-free. Now, because of that, it creates an opportunity to use life insurance for far more than just life insurance. It creates many opportunities to invest in permanent insurance with the goal of getting tax-free growth and creating a cash accumulation vehicle. In other words, the cash value component, excuse me, in a permanent life insurance policy creates many options that can be used based on the individual situation of that family. So what kind of insurance is right for you? Term or permanent? If you Google it out, you'll find that a majority of personal finance experts, say people like Dave Ramsey or Susie Orman, excuse me, they recommend term life insurance. Now, likewise, many wealth managers, they recommend permanent life insurance. Now, as I mentioned previously, we here at Wallio, we don't believe in one-size-fits-all blanket recommendations. Recommendations should be given based on your personal situation. So remember, your financial plan depends on where you start, where you're going, and what places you want to visit along the way. Permanent life insurance, it can be used for so many things. It could be used for an emergency fund, child education funds, opportunity fund, long-term care insurance. Excuse me, we're actually going to talk about that a lot more in lesson 11. It could also be used for retirement income and so many more things. We're actually going to show you in a lot of detail what the possible uses could be for permanent life insurance. We're going to go over that in lesson 12. So you have a lot of good lessons coming up. So you definitely want to make sure you come back for those guys. We have a lot of good stuff that we're going to share with you. So there are pros and cons in each kind of insurance, and it really depends on your unique situation. So here at Wallio, we recommend you look at your situation holistically, your goals and your plans. So again, keep going through this entire boot camp so you can create your own plan and find out what's going to be best for you. Okay, so you get to a point where you decide that you need life insurance. Term versus permanent aside, how much insurance do you need? So there's an industry standard method that insurance companies use to calculate exactly what consumers' insurable need actually is. This method is called DIME. So DIME is an acronym. It stands for debt, income, mortgage, education, right? So it's quite a logical method. It's actually a really good indicator on how to determine how much insurance you need. So let's assume that you are the only income for your family, right? So if you suddenly disappeared, you would want, I assume, you would want your loved ones to get all the things that you were building in your life together, right? You would want them to be debt free. You'd want them to pay off the house, have a good education for your children, and several years of income. I'm sure you would want that. Most people would. Now, there is a variable, or I should say, excuse me, a variation of DIME, right? When you can use this method to calculate what your insurable need is, but you would also add another category. This would be other expenses. So I guess you could call it DIME-O, right? So the other expenses would be specific to you and your own family situation. So what if you were to take care of your elderly parents? Or say there was someone else who depended on your income, or you had a charitable organization you wanted to continue donating to. Anything like that that doesn't fit in one of these four categories, you could put that in the other expenses, things that are going to be unique needs for you and your family. So how would this work specifically? Let's look into these calculations a little bit closer. So you can do these kind of calculations on the back of a napkin, or you could Google an online calculator and do it that way, whichever one works best for you. But let's just give an example. Say you were to put all your credit card balances, your student loans, any other outstanding debt you had, put it all together, add it all up, and say in our situation, it came up to $50,000. This is what you put under D for debt. Then for income, you would want to think about how much income after taxes, that's important. How much income after taxes would you want to leave behind for your family? So let's say in this scenario, we wanted to leave $3,000 a month or $36,000 a year over 10 years. So that would equal $360,000. Remember, it's important to remember, these are meant to be how much you would leave after taxes, because remember, death benefits are not taxable, right? You receive these tax-free. Then we come down here to mortgage. So what is the mortgage balance on your home? How much would it take to pay off your house, right? Let's say in this example, it's $200,000. So we put that, boom, right here under M. And then education. Do you have kids? If you do, what kind of education would you want for them? You want to send them to a local community college, or do you want to pay for a private education? Whatever that is, count it all up and add it in here under E. So in this case, we're putting in $120,000 right here. And then O. So again, if you have some additional miscellaneous expenses, you're taking care of your elderly parents, or you're supporting some other person or some other cause, anything that does not fit in one of these four categories, but you still want to leave money behind for that, this is what you put in O, okay, for other. So you add all of these categories together, and when you get to the total, this is what's going to be what we call your insurable need. This is how much insurance you would need to cover all your bases here. All right. So in our case, in our example, it would be $830,000 of protection is needed for this family. Okay. So let's jump into some frequently asked questions that we get. So question number one, does my baby need life insurance? Well, if you're talking about in order to protect from income loss, then no, you don't need to insure your child to protect from income loss. They're not bringing in any money, unless you have some type of child star or something like that, then maybe, but if you're not in that scenario, then no. However, I will say it is recommended to get insurance on your child, because you never know if something could happen to them as they get older. Maybe they come down, God forbid, with some kind of illness that would prevent them from getting insurance later on in their life. If you got it for them while they were young and healthy, one, it would be much more cost effective. And two, if they were to come down with some type of illness that would inhibit them from getting insurance in the future, they would actually already have that policy that could no longer be taken from them. You can't cancel it because they got sick later on, right? So if they came down with cancer or diabetes or something like that, something of that nature, that would stop them from getting insurance later. It could be of their benefit to get it while they're young. Also, let me go on another quick answer. There is a program called $1 Million Baby that sets children on a track of wealth early, and it helps them to be ahead of their competition in life financially. So if started early enough, this kind of program with life insurance, it could grow to a full implementation of a concept called the infinite banking concept, right? This is where you or your child could draw money out of that policy tax-free for life purposes such as education, emergency funds, a house down payment, or even retirement when they're older. You can actually learn more about that program in specific detail in lesson 12. So we're going to go into that towards the end of our boot camp. So I know you're, if you're interested in hearing more about that, you definitely want to come back for that lesson. Second question, does my non-working spouse need life insurance? Yes, they do. In fact, they may need a lot more than they think. You know, a lot of people think that life insurance is purely for the breadwinner only. But stay-at-home parents should have protection because they provide so many valuable services to their family. I mean, if we think about it for a second, how much stay-at-home parents do throughout the day, and added up what those individual jobs would pay or would cost in order to hire on that kind of help, it could cost a lot. I mean, think about it. A stay-at-home parent, they could be a driver, a cleaner, a cook, an accountant, a teacher, for specifically in our time, a teacher for kids at home. You know, in most cases, the monetary value of their services is just as high as if they had a full-time job. In fact, according to salary.com, a stay-at-home parent is worth almost $113,000 per year. So do they need insurance? Yes, they do. So if cost is a concern, you know, term life insurance policy might be the most efficient option for a stay-at-home parent or spouse. Or if your budget can handle it, maybe permanent insurance might be best for you. Again, there's no blanket recommendation. It's purely based on your situation. Third question, do I need life insurance if I already get some through my employer? Yes, you do, especially if you don't have enough, and that's something you need to look into. So say, for example, just to give you an idea, say you had a house and your house was worth $300,000. And then, unfortunately, that house, it burned to the ground in a fire. Now, how would you feel if you went to your insurance company and filed a claim and they told you that you only had $50,000 worth of coverage? You wouldn't be happy about that. Well, first of all, that would never happen because before you got your $300,000 house, the bank would make sure that that you had enough coverage to cover the cost of that, the value of that home before they would give you the mortgage. So you didn't have to worry about that, right? But just to give you, again, it's just an example. So what if you were to pass away, right? And how would your spouse and your children feel if they were to receive a check for only $100,000? After expenses, they could be left with very, very little and face a bleak future. So remember that DIMO method. Look at your own situation and you need to figure out what your insurable need number is. And then you should look at how much insurance you're getting from your employer. Are those numbers very close together or are they very far apart? And if there's a gap, you're going to want to start looking into different avenues on how to fill that gap so that your family is not uninsured, or I should say underinsured, right? So that's going to conclude today's lesson. So I hope you feel better and safer knowing that some of your income streams may be protected already through, workers' compensation, state disability insurance, unemployment. You have some minimums in place just in case something bad happens. However, I don't want you to be satisfied with minimums. You and your family deserve more than a minimum. Now, to those of you who are dependent on someone else's income, I want you to ask yourself a question. If you had a toaster that popped out $5,000 a month, every month, would you insure that toaster for $100 just in case it broke? I certainly would. Then why would you not insure someone who you depend upon financially? Remember, it's better to be 5 years too early rather than 5 minutes too late. So life isn't about waiting for the storm to pass. It's about learning to dance in the rain. I really like that quote. So don't wait for life to pass. Get a proper umbrella and go dance out in the rain. Enjoy life to the fullest, knowing that if a storm does come, you and your family are going to be protected and you're going to be fine, right? That does not look like a happy baby. I hope he's not looking at you like that. Well, without further ado, thank you so much for staying with us this week. I'm so glad I could share this information with you. I hope you all are staying safe and you're staying healthy, and I look forward to seeing you next week for our next lesson. Take care. Good night.